Forget about one signal indicators, and let's talk about how you should be trading if you want to make millions. The strategy that I'll be sharing with you today will save you so much time and money, but I need you to focus first on learning. I will be going over the strategy step by step, explaining everything in a simple manner for free. So sit back, relax, and grab something if you love taking notes. For those of you who don't know, SMC means Smart Money Concepts. Smart money trading is all about keeping an eye on what big players like banks and hedge funds are doing. These powerful investors can influence the market, so by understanding their moves, you can make better trading decisions. Key principles of SMC include understanding market structure and identifying areas of liquidity, such as order block levels. Don't worry, I will be explaining the concepts as we go through the strategy. The first thing we need to define in the strategy is multi-time frame alignment, meaning we need the higher time frames to be aligned with the lower ones, which is key to catching big moves with only a small risk. The time frames you'll be using depending on your preferred trading style. For swing trading, on the monthly chart, define the order flow context, the direction of the market, and the order blocks. On the daily chart, use it once the price has entered the monthly order block, and then look for market structure shift. On the 1-hour chart, use it once the price has entered the daily order block, and look for market structure shift, and then enter the trade after inducement. For intermediate time frame traders, use the weekly chart for order flow context, the 4 hours for the first market structure confirmation, and the 15 minutes for the second market structure confirmation and entry. For day traders or scalpers, use the daily chart for order flow context, the 1 hour for the first market structure confirmation, and the 5 minutes for the second market structure confirmation and entry. This is the best time frame alignment that you can use based on your trading preferences. So let's give you an example of how this will look if we put it all together. Let's assume that you are a day trader. First, you need to look at the daily time frame and define the direction. If the direction was bullish, like in this case, we now define the order blocks of interest. It can be as simple as selecting the down candles for its indication that this was the sell before the move up. The order blocks of the higher time frame don't need to be complex because we will be confirming them multiple times using lower time frames. After we define the order blocks, now we wait for the price to enter it, and we drop down to the 1-hour time frame to look for the first market structure confirmation. In the 1-hour time frame, we want the market structure to make a shift from bearish to bullish. And next, we will define our wanted order block. And we will do the same for the second time. We wait for the price to enter into the 1-hour order block, and we will drop down into the 5 minutes chart for the second market structure confirmation. In the 5 minutes time frame, we want the market structure to make a similar shift from bearish to bullish, and next, we will define our wanted order block. But it's best to confirm it using the liquidity or inducement concept. Inducement is the idea of generating liquidity to make a move, where the smart money traps retail traders so that they use the liquidity to fill out their orders and profit from the move. So in order to have a higher win rate, we need to use the inducement in our favor. It can be in the form of a support or resistant level before our wanted order block, tricking traders into an early entry only to find out that the market moves after it stops out those early entries. Although it has a downside of the market making the move without reaching your entry level, it saves you from getting stopped out before the move. One thing you need to be aware of is the time zone of your entry. You want it to be within the main trading session hours. So let's give you an example on the candle chart. How would this setup looks like? First, let's head to the major time frame, which in this case, it's the daily chart. In this time frame, we need to define the order flow context, meaning the overall direction of the market and what the price is doing in the current moment. You can do that using two methods. The first one is mechanical, meaning it's based on structural breaks. If the market is currently breaking the structure to the lower side, it means we are in a bearish order flow. If the market is breaking the structure to the higher sides, it means we are in a bullish order flow. The second method is about being able to look at the chart and easily define the direction just by looking at it. If the chart is confusing and you can't easily define the direction in 5 seconds, it's better to switch to another pair or another index. In this situation, we have a bullish order flow because the market market has kept on breaking the structure to the upside, and the current context is that the market is making a pullback to potential order blocks. So the next step is to define our daily order blocks. As we can see, we have these potential order blocks that were the last sell before the upward move that caused the break of structure. These are somewhat obvious order blocks, and they can be selected and confirmed through different rules. For example, we can disregard the first order block because after it was created, the price has returned to it and it was mitigated at this specific point, so it has a lesser chance of holding up. On the other hand, the second order block has not been mitigated, plus it has a fair value gap in front of it, and the fair value gap itself hasn't been mitigated, so that makes the order block more likely to hold. So now, after we define the major order flow context and the potential order block, we wait for the price to get into the order block, and then we drop to the middle time frame, the 1 hour in this case. We will be waiting for the first confirmation in the form of a market structure shift, and once the market breaks the structure to the upside, indicates the start of the move. Now we'll be defining the potential order blocks. It will be the first one in this case as it has not been mitigated, plus it has a fair value gap in front of it. Always remember that there are multiple ways to select and confirm the order block. It depends on how aggressive you want to be trading. In this case, this one is great. Now we will wait for the market to make a pullback into the order block, and then we will drop to our lowest time frame, the 5 minutes in this case. We will be waiting for the second confirmation in the form of a market structure shift. Once again, when the market breaks the structure to the upside, we will define our entry order block. But in this step, as I said earlier, it's better to use the concept of liquidity or inducement. By defining the order block that has the inducement in front of it, we got a better entry, leading to a better risk to reward ratio. We will put the entry order at the mitigation point and the stop loss a bit below the order block, and the target will be the high of the 1 hour time frame, or you can use a fixed risk to reward ratio. Always remember that the selection of the order blocks and the market structure breaks can play a big role in the win rate you'll get. As we can see in this example, as we first mitigated the order block, the price has broken the structure to the upside, but we only have an order block that has no inducement in front of it. It doesn't mean that it will fail all the time. It means that we might enter the position only to find out that we are the inducement. Of course, the more you practice, the better you'll get at spotting and selecting the best entries. But that's not all. Trading is a progress game, and you need to level up on every aspect of it. That's why I've made this next video, to help you succeed as quickly as possible. So click on it and watch it till the end.